ค่ะสวัสดีค่ะก็ได้เวลาการนำเสนอข้อมูลของบริษัท PSL นะคะสำหรับไตรมาส 4แล้วก็สำหรับปี 2016คุณคาริด ฮาชิมกรรมการผู้จัดการก็จะนำเสนอข้อมูลในเรื่องของแนวโน้มของอุตสาหกรรมแล้วก็ภาพรวมของอุตสาหกรรมแล้วก็จะตามด้วยคุณกุชูวาเดียกรรมการการเงินในเรื่องของผลการดำเนินงานแล้วก็ตัวเลขทางการเงินแล้วสุดท้ายก็ในเรื่องของคำถามคำตอบซึ่งก็ยินดีรับทั้งคำถามภาษาไทยภาษาอังกฤษนะคะค่ะเชิญคุณคาริดค่ะ
Good morning, everybody. As usual, we will divide the presentation into two halves. In the first half, we will talk about the industry structure, and in the second half, we will discuss the financials of the company. So just to make it clear, we are in the dry bulk tramp sector, and therefore we don't carry any containers, nor do we carry any wet cargoes or oil cargoes. All we carry are dry bulk commodities. And if you see in the dry bulk commodity space, we are in the handy size, in the Supermax and in the Ultramax space. Basically, ships that have got gear on board that will allow them to load and or discharge cargoes at different ports. This is a snapshot view of the Baltic Dry Index and shows you how the market has changed, especially in the bull years between 2003 and 2008. It also shows you how low the market has come down to, and we had the all-time low of 290 points established in February of last year. If you look at the BDI in terms of an annual average, it sort of shows it in a little bit better way. And here you can see clearly that the last all-time low was in 1986, which was at 715 points. And then last year became the lowest ever at 673 points, or basically 42 points below the last all-time low and 6% below the last all-time low. So last year was a very, very difficult year. Now, if you look at the BDI for last year, then there are, it started out the year at 453 points, then dropped to 290 points on the 10th of February, before reaching a peak of 1,257 points in November, and then closing out the year at 961 points. The fact that the market could go from 290 to 1,257 tells us that the supply-demand balance is pretty close by, and all you need is a small spike in demand or a slight reduction in supply, and you could make the market change by almost 3 to 4 times, and that's what it has done. If you look at the same market in terms of averages, then you can see the red line, which represents the average for each quarter. Against that, what we have tried to do for you is to show you how many ships were scrapped in that quarter. So when the market came down to 290 points, and in Q1 the average of the BDI was 360 points, ship owners were desperate, and almost 14 million deadweight tons of ships were scrapped. As the market started to improve, you can see how ship owners behave in a rather irresponsible manner, and they stopped scrapping ships. So as a result, the market, which had gone up to 1,257 points in November, started to come down. Now, what changed? As I said, all you need is a small spike in demand. So if we were to analyze what changed during 2016 in terms of expectations versus actuals, then you would see that as far as the Chinese export of steel was concerned, it was expected to drop by between 2 and 3 percentage points, and it dropped exactly at 3 percentage points. So the steel exports did not disappoint us in terms of any difference between anticipation and actual reality. But when you come to coal was expected to drop by 10% to 180 million tons during 2016. Instead, coal went up to almost 256 million metric tons, and that is a 25.2% increase. So between expectation and actual reality for coal, there was a 76 million ton swing. Similarly, if you look at iron ore, there was expectation that it would be a year where it would be flat or at best 2 percentage points up. Instead, the market came up with a fantastic number of 1,024.71 million tons was imported into China of iron ore, and that was 7.5% over the gigantic total which was there in 2015. So basically, if you look at China, it certainly did not disappoint us on the demand side. So, as I said, this small change in demand made such a big impact on the market that though the market had come down to 290 points in February, it also reached 1,257 points in November. So it was almost 4 times higher in November. And this tells you that supply demand are pretty close by. All you need is a small change, either in reduction in supply or an increase in demand. And ideally both, reduction in supply and an increase in demand. This is what will make the market become better. So coming to the supply side to see how that has changed. Now, if you look at the supply as of the 1st of January this year, you can see that there are almost 11,000 ships in the dry bulk space right now. Average, the total deadweight tons is 790 million tons, and the average size per ship is 72,000 tons. If you look at the lower portion of the slide and look at the last column, you can see that the net increase after scrapping, and remember we scrapped almost 28 million deadweight tons of ships. So even after that scrapping, we still grew by almost 18 million tons. So there was more supply coming in, and despite that, the market actually went up because demand grew faster than the supply was growing. If you look at the forward order book and look at what is still to come in 2017, you have almost 7.3% still there. 2018 falls to 2.5%, and thereafter it's almost at 0. We've also given you the breakdown in terms of each size category. If you look at the orders placed in any one single year, you can see that ship owners are really irresponsible. When 2007 the markets went up, they ordered 170 million deadweight tons of ships. In 2008, when the market actually collapsed from 11,793 points down to in December at 666 points, almost a 97% collapse, they still ordered 104 million deadweight tons of ships. And then when the market improved in 2010, again they ordered 104 million tons of ships. And again in 2013, another 104 million tons. So you can see the ship owners are unusually optimistic and they order too many ships. And when all those ships arrive, they overwhelm demand and we have a problem. If you look at the scrapping activities, it's almost a mirror image or an inverse image of the Baltic Dry Index. So when the index is high, scrapping is very low, and when the index is very low, scrapping is very high. So if you look at 1986 as an example, that was the last time when the Baltic Dry Index was at a very low point. You can see that we have a skyscraper which is not very tall compared to what we see today, but that skyscraper has two aspects to it which is quite different from what we have today. The first aspect is that the average age of the ships being scrapped in 1986 was only 15 years of age. And the second aspect is that this small skyscraper represented almost 5% of the total supply at that time. Today, our skyscrapers are much larger, but these two aspects are quite different. One is that they have older ships which are being scrapped. So we've not yet reached that point where scrapping will slow down in any significant way if the market is weak. And the second thing is that the percentage of ships that are being scrapped is not that high as compared to the total available supply side. If you look at the slippage, that is the difference between what is expected to be supplied in any one year and what is actually supplied or actually produced by the shipyards in that year, then you can see that up to and including 2014, this was averaging around 35%. But since 2014, the average has gone up to almost 50%. And that is because the markets have been so bad that many shipyards as well as ship owners are in financial difficulties and therefore are not able to complete these contracts. So if we were to apply a simple rule for the forward book in 2017 and 2018 and assume two simple things. One is that slippage would be at about 50%, and second, that scrapping would be about 30 million deadweight tons. Last year, remember, slippage was at 47.5% and scrapping was at 29.74 million tons. So these assumptions are pretty realistic. If we assume these realistic assumptions, we actually have marginal negative growth in 2017 and a slightly more negative growth in 2018. Now, that does not take into account all the difficult things that have happened during 2016. And I would say that 2016 could be called the year when the unthinkable became normal. And if you look at the various unthinkable items that have taken place during 2016, you would see, first of all, for the industry, BDI plunging to 290 points. This is something that nobody in the shipping world expected. So it was our own unthinkable event that happened. Second, of course, was Brexit in June. Nobody expected Brexit to happen, and the Brits voted for it. And then we had Hanjin going bankrupt on the 31st of August. Now, this is again an absolutely unthinkable event. Such a big company to go bankrupt and not be helped by the state government in South Korea was really off the charts. Nobody ever expected this to happen. Then there were two items that are related to the regulatory front and which are very, very important for us. And one is the ballast water management system, which came into force on the 8th of September last year. And then the second event is that the IMO brought forward the date by which clean oil has to only be used in ships. That is, oil with a less than 0.5% sulfur content can be burnt in ships. Currently, the oil being burnt in ships is having a sulfur content of 3.5%. Now, this comes into force on the 1st of January 2020. Then came November, in which two major events happened. One was, of course, Trump getting elected as the President of America, and the second was the demonetization of the Indian rupee in India, of certain categories of Indian rupees in India. And finally, the most shameful event that took place live on TV and thanks to social media was on all our screens within 5 minutes' time was the Russian ambassador to Turkey being shot dead live on TV. So we live in a little crazy world. Now, of these items, I want to discuss just these four which have been highlighted in green for you. So I'll just discuss item 1 and item 4 first, and then I will take you through the regulatory part of it. So the first one, Hanjin going bankrupt, what did it do? It made the people who use shipping services suddenly realize that there is no such thing as too big to fail. And therefore, they became worried, and freight rates in the container business during the month of September and October actually increased by anywhere between 50% and 100%. It doubled. And that was because people panicked and they only went to the good or the large ship owners, and they charged them a much higher price than normal. So this is good. Even in our business, it's good to have this type of a failure so that we can charge slightly better prices if you're a good company, if you're listed, you're public, your finances are open. So this was one good thing that happened. Trump winning the US presidential elections has got, I think, two major impacts or three major impacts on shipping. First is that he said a lot about protectionism and anti-globalization. But if you look at the team that he has assembled for his execution of all of these campaign rhetoric, they are all pure globalization people, pure anti-protectionist people. So like, for example, his Trade and Commerce Secretary, who's not yet been confirmed, Mr. Wilbur Ross, he's a multi-billionaire, and he owns 2 large shipping companies. So I'm sure he's not going to do anything that's going to harm shipping. So that's on the protectionist and anti-globalization view. I think that is a lot of bark but no real bite in it. Second factor is that Trump said that he wants to refurbish America's failing infrastructure. And I think this is really important. If he does that, it will allow a lot of money to be put into the hands of the normal American person who can then spend it. And American economy, 70% of it is, of their GDP is consumer spending. So it's quite important that money goes to the consumer. The third thing that Trump is talking about is being sort of fiscally irresponsible and having a big budget deficit. This is something similar to what is happening in Thailand today, but it's really required. You need a fiscal deficit to get the economy to start moving. And I think if Trump does that, it will do good for the economy, plus it will raise interest rates. And I think we have lived for too long in a very low interest rate environment, and we need to understand that this free lunch of low interest rates has come to an end. And I feel that if the Federal Reserve raises interest rates quickly, it will be good for all businesses. All the zombie companies will close down, and then only the good companies can do well. So these were the two items, and now coming to the regulatory items. Now if you look at the first regulatory item, which is your ballast water management system, it basically says, the law says that after the 8th of September 2017, that is after this year's 8th of September, any ship, it doesn't matter whether it's a container ship, dry bulk, offshore, supply ship, a container ship, a tanker ship, or a gas carrier, it doesn't matter. Any ship that comes up for its, what is known as its special survey. These special surveys come up once every 5 years in the life of a ship. So if you're 10 years old, you've got to get it done. If you're 5 years old, you've got to get it done. If you're 15 years old, you've got to get it done. If you're 20 years old, you've got to get it done. Now, when you do a special survey after the 8th of September, you have to fit a ballast water management system on your ship. Now, the cost of the ballast water management system is at least, including fitting and time, etc., involved, at least $1 million. Most ships in the dry bulk space that are over 15 years of age are valued at scrap or at roughly $1.5 million. Then you got to do a special survey on their 15th birthday or the 20th birthday, which means you have to spend another $1 million. So your ship is valued at 1.5 million, and you've got $2 million of expenses coming up. One is the special survey expense, and the other is the ballast water management system expense. So then after you've done those two expenses, your ship actually to you is valued at 3.5 million. But in the market, it's still worth only 1.5 million. So the math doesn't work. Most ship owners, having ships which are older than 15 years of age, will generally tend to scrap them when this ballast water management system comes into force. So if you look at the world dry bulk fleet, you will see that roughly 15% or 15 million deadweight tons is already at that point. So a large portion of this will be scrapped in 2018 and 2019 during these 2 years. When you come to 2020, it's even worse. So for example, if there was no scrapping in 17, 18 and 19, then on the 1st of January 2020, you would have roughly 20% of the world fleet, or roughly 160 million deadweight tons of ships, or another 45 million deadweight added to the total, which was already over 15 years of age on the 1st of January of this year, that will come up for not only doing the ballast water management system, but also of burning clean oil. Now, ships designed 20 years ago or 15 years ago were not designed to burn clean oil. They were designed to burn really dirty oil, and therefore to put clean oil in old engines that were designed for some other type of oil is almost impossible to get done correctly. So we think that again, a lot of scrapping would take place. This is the first issue. The second thing is that, say the younger ships which are there, like we have a fleet of very young ships, and we asked for a quotation from a Western European supply to buy a scrubber system. What is a scrubber system? A scrubber system allows you to burn dirty oil, but the emission from your ship will be clean, will be as if you were burning clean oil. The cost that we got from this supplier is $6.54 million per ship. How many ship owners have got $6.5 million lying around in their pockets to spend on an expensive scrubber system? So what will most likely happen on the 1st of January 2020 is that all the younger ships which are there in the fleet, they will not fit a scrubber system, but they will burn clean oil. Now the problem with burning clean oil is that the difference in cost between dirty oil and clean oil at that time we think will be at least $400 per ton. If you are burning 25 tons of oil per day in your ship, that means it's going to cost you now 25 multiplied by 400 or $10,000 per day extra over and above what you would have paid for burning dirty oil. This $10,000 will be there for every day for 200 days in the year because you're going to be sailing for 200 days. That means you'd be losing $2 million. So to buy a scrubber system at $6.5 million makes sense. You'd get a payback within 3.5 years' time. But the question is that will your clients pay for that? And as we have noticed, clients are reluctant to pay for such things. So this is the first thing. Second thing is that these scrubber systems are only lab tested. None of them have been tested in real life. Now, we know that especially the Western European companies like to cheat. We've got Volkswagen, which had a similar problem with their diesel engine cars, where the emissions were well above the standards, but the tests always showed that they were within the limits. So they cheat on the tests. So we don't know that whether the same Western European manufacturers of scrubbers have cheated the lab test or not. We don't know that. So if we buy this expensive system, we fit it, and God forbid we get caught, we will have to pay the fine and we'll have an expensive, useless piece of equipment on board, which we can't use. So that's the second issue. The third issue is that will these equipment manufacturers be around for the next 10 years or 5 years or 15 years to give us spare parts, to supply us consumables? Again, we don't know that. And we don't know whether they will be successful or not. And the price, initial price is so high, we don't have that type of cash lying around as ship owners in general. So most ship owners will burn clean oil. Now, if you burn clean oil and it's going to cost you $2 million extra and you may not be able to recover all of that from your clients, what would you do? You'll try your best to reduce the consumption of oil and reduce this cost. And therefore, you would try to reduce the speed of your ship. If you do that, then the costs would come down, the consumption would come down. But at the same time, you would take longer to complete a journey. Now, if all ships take longer to complete a journey, it means that there are less ships available. The calculation shows that if the normal speed of the ship is 12 knots, and if you reduce it by 2 knots and come down to 10 knots, then the world fleet would shrink just by that by almost 17%. So one way or the other, the regulatory environment will make sure either we scrap enough ships or we slow steam enough so that the supply-demand balance, which is almost there, as I showed you in 2016, just by a little increase in demand, a little reduction in supply, we almost got a good market. So we think that that can happen in 18, 19, and 20 onwards. So we think that the last of the difficult years would be 2017. Hereafter onwards, we think that the market should start to improve, and freight markets have this tendency to improve very dramatically. So if it goes up, it'll start going up by 40, 50, 60, 100%. You know, that's the type of movements that are there normally in the shipping world. So just some facts about China. If you look at 2016, you can see that though the GDP growth rate is continuously falling, actually all the numbers other than steel exports are going up. And this is again showing you that Brazil is taking up more and more share of the iron ore imports into China. This is quite important because the Brazilian ton mile is about 3.5 times more than the Australian ton mile, which is the other source for iron ore into Australia. If you look at it in terms of infrastructure development, China has still a huge long way to go if you compare it with America, or even so you can see clearly between India, China and USA, the gap is huge in Asia. We still need to develop quite significantly. In that case, there will be requirement for larger infrastructure development in these two countries. So what is our strategy? Our strategy is for the next 2 years to complete our rejuvenation plan. We've almost completed it. Last year, as an example, we scrapped 33% of our fleet. If all ship owners in the world had done that last year, today the market would have been higher than what it was in 2007 or 2008. But as I said, ship owners are irresponsible. They wait for responsible companies like us to scrap our ships so that they will earn more by keeping the older ships alive. So this is the one big issue in shipping. But anyway, we've done it. We've done most of the scrapping. We still have one older ship to go through. That will be done. We have 2 younger ships to come in, 2 brand new ships to come in, one in April this year and one in January next year. And that's it. We are done. So we will be have completed our full rejuvenation plan. And then once the markets improve in 18 and 19, we will start locking our ships into long-term contracts. If you want to look at the PSL fleet on a snapshot view of what it would look like, say, for example, by the end of 2018, then it would look like this, that we'd have 37 ships, we'd have an average age of only 7 years, we would have an average size of 44,000, 45,000. So we have increased in size, we've reduced in age, and we think that this would allow us to lock in ships onto a much longer term contract once the market improves. Again, the 7 sins or opportunities or threats in shipping. Very simple. Don't buy assets during the peak years. We've never done that. Sell older ships during the peak years. We've done that very successfully in post the 2007-2008 cycle. This time around, we didn't get it too right, but we think we've done the right job. Don't speculate. We don't have any speculative items on our balance sheet. Fix ships on longer term contracts. Obviously, when the markets are good, you can do that. Deleverage your balance sheet. Again, this is something that we would like to do once the markets improve. Reduce dividends to the minimum during the time when you have higher leverage. In our case, we don't have any profits for the last 2 years, so we stopped paying dividends. And then finally, buy ships when the markets are really weak. So I think we have done quite a bit of this. If you look at the blue line, that's the BDI, and if you look at the red line, that's our asset acquisition or asset disposal, and you can see clearly that we have been contra-cyclical. So whenever the markets are strong, we've been selling ships. Whenever the markets are weak, we've been buying ships. If you look at the average earnings per day per ship versus the BDI, and you can see that though the BDI fell dramatically in 2008 and remained low in 2009, our drop was not so significant, and that is because we had locked our ships onto long-term contracts. But please keep in mind, in 2008, our average age of our fleet was 23 years old. So we could not lock in for more than a year, year and a half. So after about 2 years of 2008, all the ships started coming off their long-term contracts, and then we had only short-term contracts. So therefore we were looking at the market rates. This is our forward book. The black line represents the earnings per day per ship that we've already locked in. The red line represents the total number of ship days available to us. This, of course, assumes no scrapping and only addition of 2 ships. And the green bars represent the number of days that have already been locked in as of the 1st of January this year. So you can see in the forward book that we have a reasonably good lock-in at a reasonably high price. In terms of market segmentation, if we look at Q4 and look at the whole year, the upper part of the slide shows you the comparison between the index numbers for the quarter, and you can see that on the handy size, the index was at $6,901. And ours was at 8,864, or about a 29% increase. If you look at the index for the Supermax size, it was at 8,300, and we were at 7,052. So we were down by 15% in that quarter. But if you look at the whole year as a whole, we outperformed the Handysize index by 31% and underperformed the Supramax index by a much smaller margin of only 6%. So Khushru will now take you through the financials of the company.
This slide shows you the position as far as our new building contracts are concerned. As you can remember, Saint Shipyard and Sanfu Shipyard are the two of the three shipyards with whom we had placed orders, with the third one being Shanghai Guan, from which we have received all our ships. And we have now outstanding issues with Saint and Sanfu. With Saint Shipyard, we cancelled 3 contracts and received refunds with interest on these 3 contracts out of the 12. 9 contracts where we have paid $64 million are now in arbitration in London. So this is a process which is ongoing. With Sanfu Shipyards, we had 2 ships delivered in 2015 and 3 in 2016. 3 were cancelled and we received all our refunds with interest. And now there are 2 left to be delivered. One would be delivered sometime in April and the second one would be delivered after January of next year. And we have, as you can see, about $36 million of payable on our capex program for these 2 ships. This slide gives you the financial highlights as far as the income statement is concerned. And we can compare it with the previous year being 2015. If you look at total revenues, we are substantially lower. However, if you look at the other numbers, we have done slightly or marginally better than 2015. So one being the TC income or the earnings per day per ship. In the previous year, 2015, we earned about $6,266. As against that, this year, we have earned about $200 more per day per ship. Similarly, as far as the operating expenses are concerned, we did very well there also, where we had operated our vessels at a cost of about $4,650 per day per ship in 2015, and in 2016 we reduced that cost by about $150. So therefore there is a difference of about $350 which has actually come into the bottom line, and therefore has allowed us, in spite of lower revenues, in spite of less ships which were operated, in spite of that, we had a better earning picture. If you look at it per ship basis, for example, we had EBITDA average per ship about $450,000 per ship, as against just $310,000 per day per ship. Sorry, not per day, for the year. So, and the reduction in the fleet was on an average basis was about 15%, where we had operated in 2015 with operated 45 ships, we operated 40. So we had vessel operating days which were 15% less than what it was in 2016. However, in terms of earnings, it was better per day per ship on an average basis, and operating expenses once again were also better. And this is the reason why in spite of the lower revenues, it has not impacted our earnings or losses in terms of operations as much as 2015. So we have sort of slightly performed better in 2016 on an operating basis. However, we had, as you know, impairment of assets. So we had to do an impairment of ships which we were going to sell. So only on those ships which we were going to sell immediately or in the next 1 year, we have to impair those ships. So accordingly, we had to impair 6 ships in 2015, where we had a loss of about 23 million, and we impaired 5 ships in 2016, where we had a loss of about 16 million. So this is an impairment exercise which we had to undergo. This being only on the ships which were sold. And then, of course, as you know, we sold 3 in 2015, where we had a loss on sale of 7.8 million. And we sold 13 older ships, where we had a loss of about $19 million. Now, this has more or less completed our sale program. We have one more ship, which is to be sold sometime in this year. Once that ship is sold, that be the end of our sale part. And as you know, as I said, we have 2 more ships to be delivered. So 1 ship will be sold and 2 more to be delivered will make our fleet at 37 ships, as we said, with an average age of, in 2018, that next year, an average age of about 7.7 years. In terms of the balance sheet, if you look at the balance sheet, our cash position has improved substantially. This is on account of the fact that we did some funding exercise. In 2015, we funded, or we raised funds through an equity issue, through a rights offering from the existing shareholders. After that, when we thought that we required more funds or more cash, we did about $100 million equivalent bond issue in January of last year, and then one more of about $55 million in December of last year. So we did this fundraising exercises whereby we raised about $155 million of cash. Where did we use the cash? Most of it was used for prepayment of secured debt. Because of the fact that the BDI had come down and the earnings on the freight markets were out there, were running low, the values of ships also were or are still down. So therefore, and the secured debt have loan to value covenants. So that is, if the loan exceeds 0.8 of the value of the ship, then in that case, we are required as borrowers to either add value by giving in more security or to reduce the loan by prepaying the loan. We did not have any more value to add because most of all our assets are more or less secured against our financing lines. So we had to avoid any kind of defaults on loan to value covenants, we had to prepay a lot of our loans. So we ended up prepaying almost $120 million of our secured loans. And this was mainly funded out of the debentures. And we think now that by and large, at these very low values and at the very low secured debt positions against each of the financing lines, more or less no further substantial cash should be required now, because the values have gone through their low point. So sometime in the middle of last year, we had a low point as far as the values have gone. And in the end of last year, 2016, we have seen values sort of going up. So wherever we had given some security by way of cash deposits, etc., that security now we are being paid back. We are receiving back the security because the values have gone up. So now we are getting back that security. Whatever loans have been prepaid, what we sort of managed and what we got agreed from our secured debt lenders is that whatever has been prepaid should be prepaid and applied in direct order of maturity. What this ensures is that whatever we prepaid, we do not have therefore any repayment obligations for the next 2 years on many of these secured debt facilities which we have. So therefore, one is that we do not need more cash now for these prepayments. Second is, even for our normal quarterly repayment installments, we need less money because a lot of it has been prepaid in advance. So this is what the balance sheet. So therefore, as you see, in spite of having $155 million debt or coming by way of new debt, coming by way of debentures, our total liabilities have gone up by just about $70-80 million. So this is on account of the fact that a lot of the new debt was used for reducing some other debt, unsecured debt. Of course, you must keep in mind that the unsecured debt is slightly more expensive than secured debt. Generally, as shipping companies or as ship owners, we look at secured debt, which is amortizing, that is, you have to pay them every quarter, every year, you have to repay. As against that, we have taken unsecured debt where there is no repayment obligation and there is only a repayment obligation at the end of the term. So this makes it very expensive, and generally that is the reason why most shipping companies, most ship owners do not resort to raising funds through unsecured debt or bonds, because it is substantially more expensive than secured debt. In our case, we had to resort to that, as I said, because the ship values were so low that it is not possible now to raise secured debt. One is that because of the values being low. Second is because of the fact that secured debt, general shipping banks all over the world, mainly of course Europe-based shipping banks, they are facing a lot of their trouble in terms of other shipping loans which have gone bad and where borrowers have defaulted. So because they have lot of these troubles and where they have they have been forced to make provisions or write off a lot of their loans, many of these shipping banks have more or less stopped financing ships at the moment. This is all part of a cycle. It doesn't mean that in future these banks or other banks will not lend to ships. It is just part of the cycle. It always happens. Since the last 100 years, this has been happening. When there is trouble, banks stop lending. When things look good, banks start lending again. And because of their lending, ship owners go out and buy ships or order ships, and then they increase the number of ships, the supply goes up. And because the supply goes up, it becomes an oversupplied position because of the banks which are lending. And then the markets come down, values come down, banks stop lending, supply starts reducing again, or supply starts going down by way of scrapping. And that is how the whole cycle turns. So it's not that now ships are not being financed by a bank, doesn't mean that a year later or 2 years later or 3 years later, when the market turns, the same banks will go after ship owners, forcing them to accept loans from them and forcing them to go out and buy or order ships. This is just simply something which has been happening for 100 years. Next slide gives you the operating expenses. As I said, operating expenses, we are quite competitive. And generally, if you look at the industry, we are about $1,000 less than the industry. So this year, we managed to reduce the operating expenses from $4,652 in the previous year to about $4,500 per day per ship. These are, as I said, these are fixed expenses which are incurred irrespective of whether your ships are earning or not earning. So this is something which has to be incurred 365 days a year, irrespective of whether ships are earning anything, they are on contract, not on contract, they are in the dock, they are not on dock. This is on a 365-day basis. If you compare our operating expenses with the industry averages, as you will see that year on year, generally our operating expenses are anything between $1,000 to $1,400 per day per ship, less than the industry average. So this is a competitive advantage which we carry. The next slide gives you the same thing, but in a pictorial form, where the differences are clearly visible, that there is about a 20-25% competitive advantage which we carry year in, year out. This is sort of allowed us, by and large, most of the times, even in the down cycles, to have a competitive advantage. So therefore, when other ship owners are in trouble, we also could get into trouble in terms of cash shortage, etc. But we will do it. We will get into that trouble much later than what the other ship owners would have been. So therefore, it allows us to survive and to be better with the others in the same industry. The next slide gives you the average OPEX or operating expenses or TC rates right from 1995 to 2016. The first line, the blue line, tells you or shows you how our fleet size has changed. Fleet size in terms of the average size in deadweight terms per ship. So if you see 1995 or 96, when we started off, our average ship was 20,000 deadweight tons in size. Now we are 42 or 43,000 deadweight tons in size, so more than double size. This has been a sort of natural evolution process where ship sizes have become bigger and they have become more modern in terms of their other operating parameters. If you look at earnings, this is more or less reflecting the BDI when we had very good earnings in 04, 05, right from 04 to about 2008 or even 07, even 2009 and 10. And that, as we explained, was on account of the fact that we had long-term charters at very good rates, which performed well. So in spite of the Baltic Dry Index coming down in 2008 by 95%, our earnings did not come down by 95%. They just came down by about 10-15% in 2009 compared to 2008. So that was on account of the fact that we had long-term charters with very good charterers or very good customers who continued to pay in spite of the lower market rates. Operating expenses, by and large, has been around the 2,500 to 4,000 number, except for those 3-4 good years where we sort of delayed a little bit our scrapping program because the markets were very, very good and where we were earning very, very well. So those times we had operating expenses touching $5,000 or close to $5,000, after which, after we started scrapping the older ships and when the earnings came down, our operating expenses have also come down. So therefore, if you see the gap between these two lines, the green line and the red line, the gap has been maintained. And at no point during our history have we crossed this gap, in the sense that the green line and the red line, as long as the green line is above the red line, means that on a daily basis, if you look at our operating expenses, we are doing better than break even on the operating expenses side. We would of course have other expenses by way of administration costs. We would have interest expenses. At such times, it may not break even, but at least at an operating level, we have consistently, last 20 years, with the lowest Baltic Dry Indexes, the lowest earnings levels, we have always maintained a better than break-even point, and that is purely on account of mainly, I would say, on account of the fact that our operating expenses are $1,000 at least lower. If the operating expenses were equal to or close to the industry average, as you can see, the gap wouldn't have been there. The next slide gives you a sort of leverage ratios. We had very low leverage. We had very high leverage during the Asian crisis when everything was wrong. Indexes were down, our earnings were down, but we had high debt compared to our equity position, which of 3.8 times. We brought it down to 0. Then for a couple of years, we were at 0 levels in terms of our debt. And then since we have started acquiring ships, buying or ordering more ships, these have been funded like any other shipping company. These are all funded through debt. And therefore, the debt equity has gone up from 0 to 1.26, but still at a very, very healthy level, which shows that leverage is by and large under control from a balance sheet perspective if you look at leverage compared to the equity. If you look at funded debt compared to the cash flow, of course, that doesn't look very healthy because basically there is no cash flow because of the lower earnings. And therefore, this is the time when you do not have cash flow, one has to raise cash. And that is why we have raised cash through equity and through unsecured debt in the last 2 years. So when your cash is down, you may have to raise this kind of cash through equity, through unsecured debt, through other ways like selling your non-core assets. In a sense, we have been doing that. In spite of the lower values, we have sold our old ships, even at a loss, so that some cash is raised, and to that extent, debt has come down. Every time you sell a ship, the loan on that ship is also prepaid. Next slide gives you the cash profit or the operating profit. Now, as you can see, in the previous cycle, we had a negative position in 98-99. Similarly, now in 15-16, we have a similar negative position. And on the cash side, we have a slight negative position for the first time in our history, is because, as we said, the low point is a substantial low compared to what it was in the previous cycle. The next one gives you the cash profit or the net profit. Net profit being low on account of the losses on impairments, losses on sale, etc., which are all non-cash write-offs. But if you take out those non-cash write-offs, we had a slight $2 million loss after considering interest, admin expenses, etc. Dividend policy remains the same, not less than 25%. Obviously, last 2 years, no dividend could be declared. We have had losses, and of course, we have had to raise more cash. So the question of dividend wasn't there. As and when things improve, we will go back to our consistent dividend paying policy when we think that the debt is manageable and we are in a situation where we are in a position where we see consistent earnings coming in. Financial profile does not look very good, but still substantially better than what it could have been, but for some prudent measures. One big one being that our debt position, as I said, compared to equity, because we raised equity when we required in 2015, still looks pretty good by way of 1.2 times, where now ship owners are struggling with this. Even after raising equity, their debt equity ratios do not look as good as what it looks over here. We continue to get the awards, the latest being in the last week were awarded one of the IR awards. We got investor relations. The previous year, a year back, we had the sustainability award. In terms of Asia-wide, we have been awarded the corporate governance awards. And as you know, we have very, very high importance placed on corporate governance in any manner whatsoever. It's something which is not the catchword or it's not just a slogan, but we actually try and ensure that our actions reflect the importance which we give to corporate governance. And that is then reflected by the plethora of awards and the rankings which are given. So the latest ranking from the IOD or from the SET over here once again has placed us for the 10th year in a row in terms of as excellent corporate governance with a 5-star ranking. Then there have, of course, we have had other awards on the shipping side. If you look at it from an industry perspective, we are the finalist of the wet dry bulk operators ranking by Sea Trade Asia. We were also the finalist in the previous year in 2014. Then we have also been awarded the Security and Safety Award. So this again shows all of these awards are in by way of recognition of what we try and achieve or what we try and do. Then Marine Money, of course, is a New York-based magazine which ranks based purely on the financials, ranks worldwide finance companies, the shipping companies. based on the financial statements which are disclosed to their respective stock exchanges. So this is a ranking where we have generally done very well. Last 2 years, of course, all dry bulk shipping companies haven't done all that good. But if one were to look at the subsector of the shipping companies by way of all the dry bulk companies, there again we are reasonably high rank of 8 compared to 20 odd dry bulk companies in this ranking. And because of this reason, Marine Money, notwithstanding or ignoring the low ranking which we have been lately getting, always has very, very appreciative words to say about the company. Shareholder returns still on a long-term perspective looks good. If you had subscribed to our shares in the IPO, after 23 years, you would still be left, in spite of the low share price, at about 11 times in 23 years. Not a bad return at all. Share price, of course, is right now depressed, reflecting the BDI, reflecting the market, reflecting what is happening around in the industry. So therefore, depending on when you had invested, your position in terms of current status would have looked something like this. The key here is now that if you had invested in 2010, you would have been about 30% lower in terms of the value of your investment. But if you had invested in 15, which was a bad year, as you can see, you would be still 25% lower. So which means a better position than what you would have invested in 2010, which actually tells you that investment in any place at any time should be done when the markets are low, not when they are high. Whether it is in ships, whether it is in shares. With that, we finish our presentation and throw the floor open for questions. Thank you.
ท่านใดมีคำถามเชิญถามได้เลยนะคะเหลือเวลาอีกไม่เยอะ แต่ในระหว่างนี้คงเป็นคำถามจากทางอินเทอร์เน็ตเข้ามา
We have a few questions from the net.
CAPEX for the Badat CAPEX for the Badat water system how much CAPEX
There's a question in Thai from the net which asks us what is the capex involved for a ballast water management system. So a ballast water management system will cost you anywhere between $500,000 and $1 million, as the $500,000 being the cost of the system and $500,000 to actually fit it on your ship. So about $1 million is the total cost.
and the cost for the clean oil
And as far as the scrubbers are concerned, if you go for the clean oil, continue to burn dirty oil, then you have to put a scrubber on board. And as I said in my presentation, we have a quotation at $6.54 million for the scrubber. So it's quite expensive.
our plan in the next 2-3 years for
Then the third question is on the progress of the arbitration process and how long will it take. We think it will take a minimum of a year and a half, 2 years to get to a result. That's the best case. And the worst case, it may take you a little bit more than 3 years. There's another question. Do you plan to issue any kind of debt this year? Right now, there is no need, as Khushru has explained. We have enough cash on our balance sheet, and we don't need any funding, because more or less we have prepaid all our secured debt for this year and next year. So we really have no requirement for funding at this moment in time.
I'm referring to page 30, financial highlights. Page 30. Most honorable management, Mr. Khalid, Mr. Khusro. First of all, I give congratulations to you on getting said award recently. Keep it up.
I think the mic is not working. You have to put it on.
Yeah, I have admiration to you for getting set award 2016 in this quarter. I have admiration on slide 30. EBITDA in US dollar increased substantially. Good. Gross profit margin also increased in percentage. Net profit margin percentage is reducing. The gap between gross profit margin percentage and net profit margin percentage is enhancing. How you can make it in a positive way to net profit margin can be in the positive territory, because you got the inner strength gross profit margin increasing. It means your core competency and core capability is inbuilt and instilled, and it is reflecting in EBITDA US dollar is enhancing substantially, but not showing impact on net profit margin. How you come up?
Yeah, so as you can see, the net profit is down because of the impairment loss and the loss on sale. Both are sort of cash, non-cash items. When these are not there, the net profit will sort of be higher than what you have seen. These 2 years, it's only because of the fact that there has been impairment loss on loss on sale. Without that, net profit is a reasonable number. It may not be as good as what it used to be in the past.
Okay, so your non-cash items are there. Can you show one more line, cash profit, which I have observed from Fortune 500 companies? This is not obligatory as per IFRS, but this is attractive for investor to add back the non-cash item to know the cash profit. This will show.
Row number 7 gives you the net profit or loss, excluding the non-recurring items. So as you can see, the loss was 70 million, but if you take out the non-recurring items, it is 37 million.
Right.
So that is about 50% of what the otherwise the loss is.
Can you put it in a different way, showing cash profit? This is more attractive. That's all. Another session regarding the debenture. Recently, I observed last week, there are 3 companies in Thailand, set listed, which are opting for perpetual bonds, perpetual debentures, equivalent to that. Do you also have plan in future so that there will be no?
Our plans are mainly opportunistic. So if there is an opportunity to raise perpetual funds, we will take that opportunity.
This will avoid
If it
the
makes sense, if the
issuance cost, because you repay, then you get again the loan, and then you repay. There will be issuance cost.
End of the day, everything has a cost. So there is nothing free. So there is something which is pro, something which is against. As I said, if that opportunity is there, where it makes sense, yes, we will look at that.
We have a question from the net, which says that what will be the condition of the freight market in the next 1 to 2 years' time? As I said during the presentation, we think that 2017 will be the last of the challenging years. Thereafter, the market should start to improve and improve significantly in 18, 19, and 20. So that is what our reading of the market is.
Thank you for the presentation. I have 2 questions regarding to the page number 27. It's about the market segmentation. I have a question on the company performance of the handy size and the Supramax. If you look at the above chart, you can see that the small size can make more earning than the bigger one. So please give me the explanation as to why this one happening. The second question is the Ultramax I know that the company adding more Ultramax size to your fleet. Which category that Ultramax go to, and how's the performance of the Ultramax fleet?
Okay,
Thank
so for your answering your first question, the reason why the handy size has been doing so well is because we have 4 long-term contracts on cement ships at $15,000 a day, and therefore they help to boost the overall handy size sector to outperform the market. So it's only because we have the long-term contracts there. In the Supramax, we have no long-term contracts per se. All of it is on the spot market, and therefore we have to face the market. The fact that we are slightly below the market all the time is because the standard ship used in the index is slightly better performing than the ships that we have. The standard ship used is a Japanese model, which would have cost, of course, much, much higher for us to buy. So we bought the cheaper ships from China, where the performance is not so great. So you get a very big discount on the capital value, but you have only a very small discount on the earnings, as you can see. So that explains the segmentation part. Ultramax comes into the Supramax space. So basically you will compare with them and you'll say that whatever the Supramax is, maybe the Ultramax should be 10% better. So even in the market, when you go to fix your Ultramax, you can fix it basis a Supramax index plus anywhere between 3% and 10%. Depends on your negotiation.
I think it's time.
Anyway, thank you so much for being such a kind and attentive audience, and we hope to see you at the next opportunity. Thank you so much. Sawasdee krab.